Hey everybody, this is AJ Brown from Trading Trainer, and we're gonna have some fun today. But before we get started, I always like these calls to be super interactive. So take a look at the webinar control panel up in the upper right-hand corner of your screen, if you will. And what I'd like you to notice is that there's this little thing hanging off of the edge called the grab tab, or sometimes I call it the compacted view of the control panel. And you're not really going to need that control panel. You might want to type in a question, but for the most of you, it's taking up valuable screen real estate. So you can click on that orange button with the white arrow on it, the hide control panel button, and get that thing out of your way. The other thing you can do is you could click on that full screen button, and that'll make my screen take up your full screen, because I'm going to be showing you a whole bunch of charts and tables today, and I don't want to have you squint. But finally, the most important piece is I want you to be able to raise and lower your hand, because Renee set me up with a little classroom type thing here where I can see your logins, your names and addresses, not addresses, just your names. What I can see is if you have your hand up. So why don't you all try pressing that button that raises your hand, so I can see, like, as if you're students in a classroom, if your hands are up. That's kind of the beauty of this tool here, is because when you do live events, I can interact with you. I can see who's passing out in the back of the classroom, and I can see who's sitting on the edge of their seat in the front of the classroom. In these virtual events, it makes it a little bit hard, but it turns out studies have shown that if you do interact with the person who's giving the lecture by simply raising your hand, and now we have a virtual tool to do just that, you're going to get more out of it. So I'm going to put your hands back down, and let's go ahead and get started, because I am AJ Brown. I am that guy in the lower left-hand corner. Right now I have a beard because it's getting a little bit cold, but otherwise that's me. And I'm Trading Trainer, and I've been around since 1997 trading. And then we started Trading Trainer in 2003, kind of as a, it was kind of as a need. It wasn't actually a want, because a year earlier, I started a foundation where I started to teach inner city kids what I knew about investing. And that's where my real passion is getting kids off the street. And I started with 14 kids in Denver. And now we're partnered with the Chicago Board of Options Exchange doing our training for inner city kids in Chicago. And I like taking these kids off the street. What I found out early on, though, in 2002 was it takes money to put together a charity. And so that's why we decided to pull the Robinhood thing and create a for-profit company called Trading Trainer. The cool part about Trading Trainer is that my coaches and I, we have to trade options in order to support ourselves, because every penny of profit that we create at Trading Trainer, it goes right to those inner city kids. It goes right to those foundation. In fact, all of my coaches teach in one way or another for those inner city kids as well. So we find it very passionate. What you're going to find out there with a lot of the organizations you can learn investing and teaching from is that they make more money on investing and teaching, or make more money on teaching you investing than they do on investing or trading themselves. A lot of the material folks will teach you is either outdated or theoretical, but not in use. And that's why I pride myself on the model that I created at Trading Trainer, because guess what? We have to be telling you what's current, because that's what we're living on. That's what I support my family on. That's what my coaches are supporting their family on. Now, this evening, or actually this afternoon, depending on where you are, I wanted to talk to you about some premium trading, and especially some premium trading coming up with a whole bunch of leading indicators telling us that the market might be overbought. What does that mean in layman's terms? It means that people are forecasting that, especially if tax reform doesn't go through, that the market might collapse on us. So some people are a little bit afraid to be trading premium. What do I mean by trading premium? Well, here, let me get rid of this slide set temporarily. And instead, let me pull up our learning community web portal here. So when folks join into the Trading Trainer program with us, they get access to this learning community web portal where they can get all kinds of information from us. And one of the things we have is what we call our premium tool finder. And it helps us find different picks to research, as you can see here as I'm clicking through some of the screeners results on different days. Going back to October 25, we had quite a few. And every day this screener runs and finds the best premium opportunities. And when I say premium, there's a whole group of trades. I'm just going to pull up a blank notepad so you can take notes. By the way, how many of you with the show of hands are ready to take some notes this afternoon on your last presentation of the day? Hopefully you are. I see some hands going up because I got a lot of content to be sending your way. So premium trades is usually where you take advantage of some of the components of derivatives and you use the calendar component of a derivative. When I'm talking about derivatives, I'm talking about futures and options, these things that expire. And you're going to use that to make yourself some money. There we go. Somebody's trying to call me in the middle of my presentation. So you're going to use the premium component of a derivative in order to make money. That means you're going to sell something and then you're going to hope that, and if you do it right, there's no hoping involved. You're going to plan it such that as that thing wastes down in value, that ultimately it's worthless and you get to keep all the money you made up front by selling it. It creates an income, if you will. And there's a whole bunch of type of strategies that can be considered premium strategies. People trade vertical and horizontal spreads. They trade condors. They trade covered calls. They trade covered puts. They trade diagonals. Now the scoop is no matter what they trade, the whole idea behind the program or behind trading premium is that you're looking for underlying symbols. Just bring up a chalkboard really quick. That are going to be trading in a horizontal channel. As they trade horizontally, that allows us to every cycle, and I like to trade monthlies, but a lot of my program participants trade weeklies. Every cycle you're going to make a premium, and then it's going to expire worthless, and you're going to do it again. In fact, if you want to take some statistics down, it takes approximately 3 to 7 trades. Let's write that down. 3 to 7 open positions, and I'll show you the example today, to invest your whole portfolio. And that doesn't matter whether you're dealing with a $500 portfolio or if you're doing like I am, a $7 million portfolio. You can have that whole portfolio invested in 3 to 7 open positions. Now, if you're doing monthlies like I am, on average, we have our positions cycle 4 to 5 times. That means 4 to 5 months before you either get exercised out or you get stopped out. But you're talking about 4 to 5 months. So when we look at new positions, 4 to 5 month average holding time. When you're talking about how often do we have to cycle in new candidates, 1 to 2 new candidates get cycled in per quarter. So we have a screener, like I said, And you can also screen your own symbols. Just find horizontally channeling symbols to be selling premium against. Our screener looks for, I've been tweaking this algorithm since it went live in 2008. Our screener finds the best of the best, saves a ton of time. But the scoop is that you can be really doing a good job watching candidates, putting them in your holding pattern, paper trading them, because you're really only going to need to queue up 1 to 2 new candidates per cycle per quarter. Now you might say, why are you holding these things for 4 to 5 cycles? I'm going to put in here, and I'd like you to put in your notes 4 to 5 cycles. When you're selling premium, the way that we sell premium, the profits don't accrue linearly. They accrue exponentially. Why? That's because each time you take in a new profit, the old profit from the previous cycle gets subtracted from your cost basis. In other words, not only is your denominator going up in value, but your numerator is going down in value. So for instance, if the first month you squeeze out a 9% return, the next month, instead of it being an 18% return that you squeeze out, it could be more like a 25 to 30% return. And the next month, instead of it being again linear, it would be more like a 75% return. In fact, usually around month 4, we've doubled our money in these type of trades. The idea is steady as she goes. In fact, these become very boring trades as we just wait for time to tick down. Does that make sense? How many of the show of hands that makes sense? Good, good, excellent. And so that's really what we're doing. We are being more the investor and less of the sit in front of the computer on the edge of your seat trader. And we are doubling and tripling our portfolios every year, if that makes sense. So let's look at a candidate here, because here's what people are worried about. And I got these questions even in my own workshop last night. They're worried about what happens if we break out of our channel to the down direction. And of course, all these fears are coming up for very valid reasons. We have a ton of leading indicators, everything from soft data where HSBC, Citibank, Merrill Lynch, they're all saying, Morgan Stanley, they're all saying that the market's overbought, that the bubble's going to burst. And then of course there's the worry about tax reform, and it just, the VIX is incredibly low and the market's incredibly high. And history tells us that that is a precursor to something happening. Not to mention that the Federal Reserve is wanting to raise rates when they can, and they also have a huge debt. It's called the leftovers of quantitative easing, right? That they're going to want to start taxing our economy to get paid back. They've been talking about it for months, yet they have yet to pull the trigger, but they want to start unwinding that big giant IOU that we have with them. So there's a whole bunch of forces that are hinting at this euphoria in the market can't be going on for yet another year. It's one of the longest bull runs in history. So people are saying, AJ, I don't want to get involved in a premium trade because I know what that means. Every time, every cycle where I sell premium, by definition, when you sell an option or sell a future, you have an obligation. If the person you sold it to comes and exercises their right, you have an obligation to do a transaction. So you're under a commitment. It's almost like you're on a 3-month cruise or something, and there's no place to go but jump in the water if there's a problem. And that usually means sudden death. How many with the show of hands follow? So they want to know about, how do I set up these premium trades to protect myself if something breaks out down rather than break out up. Everybody is somewhat familiar with the covered call type program. where we again would love for this thing to go sideways because we can continue to collect our rents on the underlying symbol. But if it pops up, we would get exercised and we would get to take our profit that we've accrued to date. But what happens if it breaks down? So a lot of people are saying, well, what do we do? And today we're going to be talking about writing covered puts, and then an added piece of the puzzle, which would be doing a diagonal put debit spread, which sounds like a mouthful, but as you watch what we do here, you're going to see that it's no big deal. Last night in my own workshop, we worked on a ticker called ETE, Energy Transfer Equity. Now, notice this is a 6-month daily chart, and we like this one because it's established for itself a nice line of resistance and a nice line of support. In fact, we've kind of identified a tested line of support at $16.50, tested line of resistance at $18. I'm going to open up another scrap paper and we'll take notes of this. Please follow along. Support. We've identified it to be about $16.50. Resistance, about $18. Now, I'm going to do what I call a scenario analysis test. That's where I'm going to go through with the numbers I have right this minute and kind of work up what a buy right would be for a covered call, because from the covered call analysis we can then easily branch out to the covered put analysis, and then from that the diagonal debit put spread. All right, and I can also show you how in doing this analysis I can build in safety factors so that when I actually go to the trade and I leg into the trade, which is, by the way, how we contradict the low implied volatility in options right now, by legging in. And that's why we like these ones that cycle up and down, cycle up and down. We can create for ourselves a very simple plan that we will follow in order to pull out a nice profit. So let's get right to it. So the first thing I would do was I would buy to open some of this stock. Again, we're going to go through the simple covered call writing analysis first, and from there branch off to the other ones. We're going to do this in a short amount of time. Let's get right to it. Buy ETE. It's currently trading at $16.38. And then the next thing we're going to do is we're going to look for a covered call to sell. And I'm going to sell out in December. We have options expiring today for November. So I'm going to go out to the December. And let's go, since we're trading at about $16, let's go slightly out of the money here. We'll go with the $17. It's trading between 25 and 30 cents currently. So we'll just, for our scenario analysis test, we'll say 27 cents. Now I know you got to buy it on every nickel, but we'll put this in here because this is just a math problem for us. ETE, December 17 call. So we bought some stock, we sold a call, and that winds up with a cost basis. Remember that call becomes an instant dividend or a profit buffer for us. $16.11. Cost basis is otherwise known as the break-even price, right? Now, where would our max profit on this happen? Our max profit on a covered call is going to happen to the top side, $17. So we could say max reward, otherwise known as profit, in this first cycle of transaction would happen at $17. How many with the show of hands are following? Excellent. Then the next piece of the puzzle, of course, is how much profit would we make? $17 minus $16.11 would give us 89 cents of profit. And we like to know what that is in a percentage. So of our cost basis, we're talking about 5.5%. The more important piece is, what is our max risk? Now this would be to the bottom side. Where would it be? Well, it would be where we get bailed out. Where are we going to set our bailout price? Well, over here, we had a low of $15.82. Bailout price is where I'm ready to just toss the towel in. If we got as low as 1582 in this latest horizontal channel, how about we go for something like 1570? In other words, it's a price we haven't been at for a while, or haven't been out at all. And if we get down to that price, we're ready to say, oh gosh, the proverbial poop has hit the fan and we're out of here. So 1570. Now, how much would I lose? Now, I can do this one in my head, but just as long as you're following along here, $16.11 minus 1570, I'd lose 41 cents if I got called out there. Now, 41 cents, of course, of our cost basis would mean we lose about 2.5%. Now, we can determine from this our position sizing, can't we? If we've got our max risk, 2.5%, everybody has their number of what is the max allowable risk to your portfolio that you would allow. I always recommend to my program participants to have it somewhere between 1 to 4%. That means not one trade can have any more than a negative effect on your portfolio of about 4%. And I generally say, you know, use that bigger number with a smaller portfolio. By the time you get into six figures, you should be closer to the 2 to 1%. Let's just use 2% in this analysis here. If we have a 2% max allowable risk to our portfolio, and we have the max risk evaluated in this trade of 2.5%, we could put about 80% of our portfolio into this trade. That means we'd need about 2 trades like this and really to balance out our whole portfolio, right? Now, 80% of our portfolio, I'll pick a random number. Let's say we have a portfolio of 20K that we're investing. You might have less, you might have more. That means we were playing with about $16,000. If I was to use my cost basis of $16.11, it says I can purchase 993 shares of this transaction. Now, here's where the safety factor is built in. Hope you're taking notes. First of all, options, unless there's a special situation, which over the last 18 years of trading I've seen only a couple times, are in lots of 100. That means that 93 extra shares is not going to do us any good. So already we've built in a safety factor into our analysis here, because our step 1 will be purchase 900 shares of ETE. Here's the trick: after a bottom has been found. And we want to get a better price. Now, it's going to be a little bit tricky, but not too tricky here. We'd like to get a better price than 1638. buy at less than $16.38. Remember, when you're buying anything, the better deal is to buy low, right? When I buy something, I want to buy it for as less as I can. Buy it less than $16.38. Then I would create my step 2. Write 9 contracts of ETE December 17 calls. Here's the important part. After a top has been found, sell at greater than. Remember, whenever you sell something, you want to get a better price than you did. Sell at greater than 27 cents. That's what our analysis says. So now we have 3 areas in this analysis that are going to be a safety factor. First of all, in the position sizing, because we wound up going with fewer shares than our portfolio would allow. That already reduces the risk and increases the profit right there. Second, by targeting prices on our buy side greater than our analysis, and on our sell side, this is where legging in creates the big difference. We're going to make a much different set of numbers when we actually go to do this trade, simply by doing first step 1, then step 2. In fact, I was saying, since we're at the bottom of our channel and a bottom seems to be establishing itself over the last couple of days, we might have a little bit of a challenge, but I think if you play off of, for instance, the amateur hour volatility, you might be able to save a couple pennies, and every penny counts, but you might not do much better than maybe $16.30 for your buy price after you've made sure a bottom has been found. And then as you wait patiently, like for instance, the last time it took about 10 days to get back to the top. Last time before that, same. We see here that the bear does tend to like to jump out the window more than it likes to climb the stairs. But by the time we're trading back up here and a top has been found, like it has over the last couple of cycles, beating this price of getting more than 27 cents for the December 17 call is going to be easy peasy. In fact, you'll probably be able to sell a higher premium, an 18 call, and still do well. Now, one caveat on part 2, remember the option part is your premium part, meaning that time decay is happening. Correct word for that is theta decay, but time is passing by every day. And so we actually have kind of a deadline. If you look at my calendar here, the deadline is going to be the Wednesday before the option expiration. So around December 6th. So let's put in parentheses here, December 6th deadline. By December 6th, because the premium will start really decaying more quickly, we have to make a decision whether we found a top or not, whether to sell the premium or whether to let our long position run. And that's got a little, that could be a whole call all by itself. So I'm going to not touch that right now. Let's go ahead and summarize this one analysis all up, and then let's jump into the next ones. We have a profit zone. Our profit zone is going to be anywhere from our cost basis, $16.11, up to $17. And our trade zone is going to be anywhere from our bailout price, which is going to be $15.70, all the way up to, again, our exercise price. Now, when we leg into this, obviously, if we can get a better strike price because our price is up here, our underlying symbol's up here, our actual profit zone might be into the $18 range, maybe even into the $19 range, depends on what premium we sell. And then depending on the prices we get, if we can get a slightly lower price for the stock and a much higher price for the premium, we might have a lower cost basis. It's not uncommon when you leg into these positions that your profit zone is bigger than your trade zone. In fact, that's something you strive for. Let me tell you why. If you're, write this down, if your profit zone is greater than your trade zone, you have something called a risk-free trade. That means instead of discussing the topic of the difference between max reward and max risk, you're actually discussing the topic of what is my max reward versus my min reward. It's a win-win trade. So that's also, again, the importance of the two-step process. Some of these premium strategies we have are like buy rights. They don't allow us a two-step process, but the diagonals, covered puts, and covered calls allow us very well to create a nice legging in opportunity, which compensates very well for the implied volatility argument that people throw our way. Yeah? The other component I want you to look at is, again, up here at the top for our channel that we identified from the beginning, $16.50 to $18. Our other intention is to grow this to have our profit and trade zones bigger than our channel. What does that mean? That means not only do you have a risk-free trade when your profit zone is greater than your trade zone, but now you have a trade that's not going to knock you out prematurely. It's going to allow you to run for the length of the channel and attain that 4 to 5 cycles that I go for. To be honest, the best one I ever did lasted 14 cycles, 14 months. I've been trying to get 15 months. That was in 2008. I keep getting to 14 and then I get exercised. When you're around 14 cycles, you've more than tripled your money in the trade. So again, we strive for something that's, not only that, if you just go cycle and cycle of selling premium, it's a very simple and boring way to trade. Yes, it's very lucrative, but you're not having to do all this like screening, and you just sell premium each subsequent cycle. I rather babysit a candidate that I know very, very well than introduce a new candidate I don't know. Let's take a look at the covered put really quick. I'm going to open up another one because this is where people have been concerned. Now, I hope that I made enough of an argument here that shows even if you do a covered call, if you do the covered call correctly, even if you get knocked out to your bailout price, it could be a min reward situation even on cycle 1. But here's where a lot of the folks in our program are going. Instead of buying to open ETA, they're selling to open ETE. That means that they're actually doing a short. They're shorting the stock. And then what they're doing is they're shorting the put, or they're writing the put. So let's go and look at the put. $16, which is slightly in the out of the money, is trading between 36 and 38 cents. So we'll go with 37 cents. In fact, what I'm going to do here is I'm going to copy this so that it saves me a little bit of time, so I'm not typing it all out for you. So we're talking about, I think I just said 37 cents. Let me verify it one more time. Yes. So 37 cents sell to open the ETE December 16 put. And so that means our cost basis, our break-even price, notice we're selling in both cases. First, I shorted the stock, then I sold or wrote the put. So because I'm selling versus in our situation where we covered call wrote, buying and selling, I now add these two numbers, right? Because I'm doing two selling transactions. So my cost basis actually becomes $16.38 plus 37 cents, $16.75. My max reward is if I'm going to get called out at $16. That means I'm getting called out to the bottom side. I'm getting exercised at the bottom side. That means if the market crashes and your individual symbol crashes, you profit. You get your max reward profit, and that's why people like this strategy. It's going to be 75 cents. $16.75. That means my return on this particular would be 4.5%. My max risk or loss now would be towards the top side. Where would I put my bailout price where I would buy to close this thing? I had this pop up in price right here with a high at 1871. So why don't I go with something nice and safe over at 1880? So my max risk or loss would be at $18.80. Notice the loss now is to the top side instead of the bottom side. 1880 compared to 1675 means I'd lose $2.05. That gives me about 10.9% loss. Now, if I was going to do position sizing on this character, 10.9%, and we go with our 2% that we agreed we wouldn't want to risk out of our portfolio. That means we could put about 18.3% of our portfolio in this trade. That means we would need about 6. We would need 5 more candidates just like this to invest our whole portfolio. Not a big deal. Easy to manage 5 candidates, 6 candidates, 2 candidates. But it's not about managing a ton of day trading or anything like that. All right, so we went with a hypothetical portfolio of $20,000. I'd be investing $3,660. My cost basis is $1,675. We're talking about 200 shares. So in this case, we would short 200 shares of ETA after a top has been found, and we want to sell at, remember, whenever we sell, we want to get a better price, greater price. Sell it greater than 1638. Once that's done, we're going to then write 2 contracts of ETE December 16 puts after a, again, bottom has been found. Sell at, and here we want to get a greater price than 37 cents. Don't forget our December 6th deadline. What's our profit zone? Our profit zone is anywhere from our $16 exercise price up to our cost basis of $16.75. What's our trade zone? Our trade zone is anywhere from our exercise price up to where we would get bailed out at $18.80. Now, you compare these two, and remember, we're going to do the same thing, leg into these. So these numbers are basically lines in the ground, and we're only going to get better. We're going to reduce our risk in both cases. We're going to increase our profit in both cases. Our goal is to get our trade zone smaller, or I should say our profit zone bigger than our trade zone, and we want to encase our channel. I highlighted the wrong thing over here. Our channel, so that we have a trade that lasts a long time. You could do it so that you profit to the bottom. You could do it so that you profit at the top. Remember, in both of these cases, if you create, and this is why I like premium trading like this, because this is rifle shot. There's a lot of other trading out there you could do with derivatives, like directional trading, where you leverage a stock replacement like a long call or a long put, or you do some premium trading on implied volatility ahead of, earnings or news announcements or things like that. That's more of a rifle approach where you have to play your probabilities. Here we've got a plan. We've got a 2-step plan. We execute it like clockwork. We let the theta decay work. And we have a queue, as I said in our notes. We have a queue from our screener of candidates that we're constantly taking out on dates to see if we like them, to see if they do anything crazy while we're waiting for an opening in our portfolio. Whether it be 2 trades that maxes out our portfolio, or 7 trades or 6 trades, it becomes a very easy thing to manage. You can profit to the downside, you could profit to the upside, but do recall that whether it's right from the get-go on cycle 1 or after the first cycle where you've taken in a second premium and lowered your cost basis further, it's not difficult to get your profit zone to be greater than your trade zone. And so that means whether you're talking covered call or covered put, you're not discussing max reward and max risk, you're discussing max reward and min reward in both cases. That means even if something breaks to the downside on a covered call, you're still going to walk away with a nice money. And we didn't even talk about the diagonal component. We didn't even talk about marrying calls and marrying puts, the adjustment strategies you can use. This is just setting up the basic trades from the get-go. I wish I had time to get into how we can convert this as well as this into diagonal debit spreads. It's very easy, and it's something we talk about in our program. I'm going to have to leave you with a cliffhanger on this, but it's way worth your time to delve into this type of investing. It's what our whole program's about. We call it our 6% protocol program. We've got a couple of different screeners that are constantly running. We've got all of our educational material. In fact, the whole scoop behind the 6% protocol is we actually have a weekly workshop that we bring everybody together. People ask questions, and we go through examples just like this. And then we have live forums that you can find here under the Learning Center and in the community forum, where, of course, it gives me trouble. It always gives me trouble. It doesn't give anybody else trouble, and I'm so excited about that. That's because I enter in as an admin all the time. But as you can see here, we've got areas where people are doing their 6% protocol trading discussions. We put our weekly workshop notes up there. And as well, we put all of our videos. We've been putting our videos up there since 2008. So you've got all your tutorial videos, all of that good stuff. Listen, I wrote this stuff up in some pretty nerdy white papers, and I want to give you those today. So I'm going to put a website up on the screen for you to go get these. These are free white papers that explain everything, plus the diagonal components, so you can read through it on your own time. And I'm also going to give you a cool link that's going to give you a discount in order to get this program here. First, let me give you my email address, because some of you might have questions about what the heck I talked about today. And let me make this nice and big and fat for you so you can see what's going on. I'm AJ at tradingtrainer.com. You can call me. If you're international, you'll put a +1 in front of it. You can call me. I'm at extension 81. You might get my voicemail, but I always return my calls. And the URL for the white papers, I'm going to copy and paste it right here because that's just easier to do, is 6pp.today/videos-and-white papers. In fact, let me throw that right into the chat section, unless Renee already, no, let me do it. There it is. I put it right into the chat section. If you follow that link, let's see what happens. I just had a Chrome browser open up here on my computer, and wait for it. Yeah, you can put your email address in there and get yourself some videos and the 3 white papers. They'll be emailed to you. And then the other one I wanted to give you, because we're giving a special, is this link, which is, oh, that's an easy one. 6pp.today income from options, and I'll put that one in the list as well into the chat area. Oh, and Renee's copying me too, so she and I are on the same page. And if you click on that guy, oh, I'm sending it to organizers and panelists. See, Renee's sending it to the public. It's a good thing that she's following.
Hey there. Welcome.
See, there's me with a beard. If you go to that page, it'll explain everything about the 6% protocol program. We've got a special price, but if you actually, and I shouldn't be saying this out loud, but I'm going to, if you actually try to exit this page, you'll even get a better deal. And so you can pay with credit card, pay with PayPal, try exiting the page and you'll see a pop-up give you an even better deal. But just read through it. I want, see if it's a match for you, because even if you're an active trader, this is something you can do on the side with some of that money that you have stored away in Bitcoin or gold or mutual funds, because this type of premium trading is all based on just time passing by. It's not based on directional movements. It's not based on implied volatilities. And it takes the number one comment I get is that people get bored doing my trading. And I say, well, why do you keep doing it? And they say, AJ, I've been doing it with you since 2008 because it's freaking lucrative, but it's boring. So boring and lucrative is good for me. I'll take that anyway. If you want to call me boring, go for it. So here are my links. And please take advantage of contacting me personally if you have questions about what we talked about today.